Welcome to module number 4 of our IFRS 12 e-learning course. In this module, we will dive into the detailed disclosure requirements outlined by IFRS number 12. We will cover the presentation of consolidated financial statements and the specific disclosures related to the interests in subsidiaries, associates, joint arrangement, and unconsolidated structured entities. Let's get started. First of all, IFRS number 12 places significant emphasis on the transparency. Let's explore the specific disclosure entities are required to make under this standard. Number 1, the entity must provide clear presentation of consolidated financial statements. This includes a balance between providing sufficient detail and avoiding information overload. Number 2, the company also must comply to the disclosure requirements related to the interest in subsidiaries, including the name, country of incorporation, and the proportion of ownership for each subsidiary. It is essential to highlight here that any significant restrictions on the ability to access or use assets and settle liabilities must also be disclosed. Also, for associate and joint ventures, entities must disclose their significant judgments and assumptions used in determining the fair value of the investment. Additionally, details on the nature and extent of the entity's interests, including any restrictions, are also required. And finally, the entity must also provide disclosures related to the unconsolidated structured entities about the nature and extent of the risks associated with those entities. This includes details about the risks that the entity is exposed to and how it manages those risks. Consolidated financial statements provide a holistic view of the group financial position, performance, and the cash flow. So let's break down the key components. Balance sheet, which is a statement of financial position, the entity must provide presentation of consolidated assets, liabilities, and equity. And when it comes to the statement of the profit or loss, the entity must provide consolidated revenue, expenses, gains, and losses. And also the entity must provide consolidated statement of cash flow, which combine the operating, investing, and financing cash flow for the group. And the last financial statement that the entity must provide is related to the statement of changes in equity, which is showing the changes in the shareholders' equity during the reporting period. So if company A, for example, owns 80% of company B, then the consolidated statement of financial position will be prepared as follows. Company's A total assets are fully included in the consolidated statement of financial position, and for company B assets, the 100% of these assets are included in the consolidated financial position, not just the 80%. Why? The 100% must be considered because you are going to consider non-controlling interest as part of your shareholders' equity. And regarding the liabilities, company A's total liabilities are fully included in the consolidated financial position. And also for company B, you will consider 100% of the liabilities, ignoring the percentage of ownership that you have in the other entity. So 100% of the liabilities will be included in the consolidated financial position. When it comes to the equity, be careful because company's A equity is fully included in the consolidated financial position. And the equity section includes the non-controlling interest, which is 20% in this case, to present the portion of the subsidiaries that's being not owned by the parent. So when it comes to the equity, only the capital of the parent is included and the capital of the subsidiary is not included. And also don't forget to add the NCI as we explained, because you consider 100% of the assets, you consider 100% of the liabilities, so you need to consider 20% as part of the shareholders' equity under the line item called non-controlling interest. And this 20% refers to the portion of the subsidiary not owned by the parent. So in summary, regarding the consolidated financial position, all assets, all liabilities of both company A and company B are fully consolidated. The ownership percentage affects only the equity section. where the non-controlling interest reflects the portion of the subsidiary not owned by the parent, as we explained before. Now, when it comes to the disclosure requirements for our interest in subsidiaries, we have to provide information on the subsidiaries regarding our interest in these subsidiaries, including any non-controlling interest. So this will include financial information, contingent liabilities, and any restriction on the ability to access or use the assets. And when it comes to the interest in associates and joint ventures, so the entity also must provide disclosure, including the nature and the extent of the entity's interest and significant judgment applied in determining the fair value and any restriction on the ability to access or use the assets. So, for example, if company C has a joint venture with company D, the disclosure should include details about the joint venture's operations, risks, and the proportion of the ownership. And when it comes to the disclosures related to unconsolidated structured entities, the entity must provide disclosures to cover the following: the nature and the extent of risk. So entities must disclose the nature and extent of their interest in unconsolidated structural entities, including the risk involved. And the entity also must provide information about how the entity managed the risk associated with its interest in unconsolidated structural entities. So for example, if company E has investments in unconsolidated structural entities, so disclosure should outline the specific risks such as the market or credit risk and how these risks are being managed. And above all, the entity must provide disclosure regarding the nature of this unconsolidated structural entity. What is the objective of this type of entities? Is it related to a specific project? So what is these projects? So all of this information must be disclosed. In summary, this module has covered the detailed disclosure requirements outlined by IFRS number 12. From the presentation of the consolidated financial statements to specific disclosures related to various interests, transparency is the key. In the next module, we will explore the aggregation and materiality considerations under IFRS number 12. Thank you again for your attention, and let's continue our journey through the International Financial Reporting Standards.